Hey, welcome to another exciting Thursday. It's January 18th. Yes, we're already halfway through the first month of the year, and so many exciting things are happening in the world, but we're going to focus on just the things that are happening in the world of mortgages, home finance, and your ability to buy and maybe sell your home. And who better to ask those questions and get those updates from a 42-year veteran of this industry. His name is Art Alvarez. He's joined us now from Mortgageworks. Art, welcome.
Hi, Jeff. How are you?
You know, you look like a kid for a guy who's been in the business for 42 years. Congratulations.
Well, I was hoping you were going to say I was a 42-year-old mortgage originator, but I'm afraid that would be a little understated.
We're just grateful that you have 42 years of experience, and so exciting show. A lot of things going on. I know some
Yep.
things in the Fed have gone up and down and sideways, and I can't wait to hear all that. I'm going to turn it over to you, but before I do, I just want to remind people, hey, if you're joining us live, make sure to put your comments in the comments or your questions in the comments section. I'll be behind the scenes and I'll be grabbing information and giving it to Art. He likes to answer those questions because, hey, he's from MortgageWorks where they have the answers and they're on the house. With that, Art, I'll turn it over to you.
Okay. Thanks, Jeff. Hello, everyone. Welcome to this week's Mortgage Minute. I'm Art Alvarez, where Jeff is right. We do have the answers and they're on the house. As you know, we like to jump right into giving an update on mortgage rates. And so I want to do that right now. Jeff's going to pull up our rate grid from our website. There it is. You know, I would say rates are hanging in there, but not to be a party pooper somewhat, but they're actually up a little bit from mid to late December. And it's something I'm going to get into in a little more detail. And of course, the best indicator of where we're at with mortgage rates is that 10-year bond chart. And what's interesting about this is that, you know, it wasn't too long ago. It was about right about Christmas time, right after Christmas, that week between Christmas and New Year, we had a pretty good dip in the bond yields where we actually got close to a 375 on the 10-year. And so I can recall at that point, we were actually looking at a conforming 30-year fixed with no points. We were actually briefly at about 6%, but you can see from this rate table, we're up a bit to right now about 6 3/8. And so, you know, what is going on? What happened to that optimism that we were expecting a whole bunch of decreases in the Fed funds rate this year? And that was, of course, I think part of why the bond yield had dipped. But there seems to be a change of sentiment in that regard. So I want to kind of go into what I see as a couple of reasons why that's occurred. And yeah, there's Jeff's bond yield. Unfortunately, there you see it. It's just about 4.15, and that 5-year trend, as you can see from last Friday to today, that's not the kind of trend we want to see. We want to see the opposite, sort of the more downhill slope if you're if you're out skiing. And unfortunately, this looks like you're not climbing Mount Everest, but you're certainly got a little bit of a mountain climb here from where we were last Friday. So what is going on? What is triggering this? Well, the first thing I would tell you is, by the way, this current yield, of course, today we're higher than the 412 that we had on this slide when we prepared it yesterday. Now at basically 15, that's about a 5-week high. And so the trigger points I think that's causing this are a few things. First of all, the next one on the slide there, it says Fed speak. A couple of comments have come out this week. Fed Governor Waller, he came out and did a speech and said there's no reason to move quickly to lower rates. Now, he does see an opportunity to lower rates this year, but he's urged caution and says there's no reason to move quickly in that direction. New York Fed President Williams, he was a little more adamant about, and again, in a speech he did earlier this week, where he basically said there shouldn't be any rate cuts until we get to 2% inflation. And as you know from past episodes of this program, and if you track this stuff anyway, while we've got great improvement on inflation since it hit the peak of 9%, over a year ago, you know, we're still in the more a little low 3 range on inflation. And so we're not quite to that 2% target that the Fed wants. That's why the New York Fed President Williams says, hey, look, we shouldn't be cutting the Fed funds rate at all until we get to 2%. So those kinds of public comments were not helpful to the bond market, which is part of the reason we've seen the bond yield trickling back up after the first of the year. And then, of course, yesterday, was the retail sales number. And it was, as the new favorite term is used, it was considered hot. It was a 0.6% jump in December when only 0.4% was forecast. So what that implies is that, the holiday retail rush, holiday sales were actually, essentially better than expected. So a big jump in the retail sales for December. That's another data point that suggests the economy is actually doing pretty well. And of course, when you have a good economy's growing, that's not necessarily going to be helpful or friendly to the bond market. Hence the increase in yields that we've seen over this last several weeks. And then today was the initial jobless claims, and as you can see on the slide, they were forecast at 208,000. But guess what? They came in at only 187,000, much lower than expected. In fact, I think it was about a 16-month low on jobless claims. And again, jobless claims means people who are filing for unemployment. And of course, it was 202,000 in November or last week. So that was a much lower number than expected. And given that came out today, that's part of the reason you're seeing that 10-year bond yield at that peaking at that near 4.15 range. And then the Philly Fed manufacturing survey was forecast at minus 0.8. It actually came in at minus 0.106. So it actually continues to be weak. So yeah, a little bit of a mixed signal there on these data points. But overall, the economy looks pretty strong. The labor market looks pretty good. Inflation, while much better, much lower and more under control, it's not yet at the target. Hence, that's why yields have come up a little bit, and why the Fed, these folks at the Fed are saying, "Hey, slow down. Let's kind of tone down this optimism." In fact, even the European central banks have come out this week to say no rush to lower their target rates. So there's some pretty strong signals there that optimism that we saw in mid-December after that last Fed meeting, where they seem to be implying that they're ready to start lowering the rate. I don't think we should grasp that too much longer. I think we're in for, as I have at the bottom of the slide, on rates higher for longer. Just, I've seen a lot of news headlines on the financial pages about, mortgage rates plummeting and the housing market set for a big rebound because rates have dropped significantly. They're at a 8-month low going all the way back to May. And as I pointed out on this program before, back in May, when we were at these levels, low to mid sixes, no one seemed to think that was very good at the time, but it's all about perspective. When we got up to, in the sevens, mid sevens in October, now that we're, about 1% or so lower, that seems to be described as a big reduction in rates, rates plummeting and rates sharply lower, but I would suggest not quite so much. So I think we're going to be at these levels for an extended period of time. And I think we just need to grasp that and basically move on with plans if you want to buy a house. And again, we can help you sort of defray the cost of a mortgage in terms of things like buy downs, temporary buy downs in particular, so that you can be in a position to look at buying a home now rather than later. And I think now rather than later is a good idea, as I've said many times, because once rates do drop more significantly, that will bring more inventory on the market, but that'll bring a lot more buyer demand. And I think ultimately home prices will actually go up from here, not go down. So there's your rate update. The next thing I want to talk about is it's kind of interesting. It's something I saw on the news page, and it really caught my attention. And I want to kind of go over it because I think this is a classic, really good example of how you really got to beware of the headlines, and frankly, a good example of fake news or misinformation. So I was astonished after I read this short article, particularly after I saw this headline, because of course the headline is what got my attention, which you can see it right there. This mortgage company is offering 2% interest rates right now. Well, obviously I knew there must have been a catch. And so once I read the article, of course, there is a catch, and frankly, outright misinformation in this article. It was published in Go Banking Rates, and I saw it on the Yahoo Finance news page on January 10th. And so what was it all about? Well, it turns out the article was profiling a company called Rome. Now, this is a platform started in September of 23. So it's a pretty new outfit. They're not a mortgage company at all. So hence, that title, that headline, this mortgage company, that's just flat out a lie. That's not a mortgage company. They are essentially, when you read the article, they're essentially a broker. What do? Well, they offer listings of homes with assumable mortgages, primarily FHA and VA. As we've touched on before, FHA and VA loans are assumable. USDA loans, by the way, also are assumable. And so that's really what they're promoting here. They're not a mortgage company. They're not offering 2% on, originating a new mortgage at all. What they're referring to is they're essentially more like a real estate broker, where you can go to them and they'll present you listings of homes that have assumable mortgage with low interest rates, loans where they were made in 2020, 2021, when we were in the 2s and the 3s. So that's really what they do. And the other part that was kind of frustrating in reading it, the details of the assumption part of this scenario of this opportunity, is the article said that in order to assume a VA loan, you had to meet U.S. military service requirements. That's not true. And I've covered that before. If you want to assume a VA loan, you're looking for a home and you find a home that's got an existing VA loan, maybe it has a 3% mortgage rate, and you want to inquire about assuming that loan, you do not have to be a veteran to assume that loan. You don't have to have any military service record at all. So that article was flat wrong to suggest that. The other thing is it talked about FHA assumptions, where it talked about you had to be a first-time home buyer to assume an FHA loan. Again, not true. The FHA loan program has never been a first-time home buyer program. It's never required that you be a first-time home buyer, whether it's, haven't owned a home for the last 3 years, which is the mortgage definition of first-time home buyer. That or otherwise, you don't have to be an FHA, or you don't have to be a first-time home buyer to assume an FHA loan or to get a new one. So again, the article is completely wrong, not true on that point. As it turns out, what Rome does is they charge a 1% fee to guide, quote unquote, a home buyer through the loan assumption process. Now, in that respect, I think it's kind of a clever idea. I'll give them credit for that, because the loan assumption process is just like getting a new loan. You're going to go through pretty much the exact same process as if you came to me and said, I want to buy a house down the street and I want to get an FHA loan. I'm going to have to gather up quite a bit of documentation from you, income documentation, asset, bank account documentation, tax returns, maybe if you're self-employed. A lot of documentation does have to be collected. And so what this company is offering is to essentially assist that prospective home buyer with gathering those documents and then submitting them to the servicing department of the lender who is servicing that existing loan that they want to assume. And so in that respect, I will give them credit that that's a valid service to offer. I would question whether or not 1% is reasonable. That could be a pretty large amount of money, depending on the loan amount. It could be easily $4,000 or $5,000. But at the same time, loan assumptions, that they're known historically in the industry to be a tough process. They take a long time, and in large part, it's because it involves not having someone who's expert at loan origination and at how to essentially compile a loan file with documentation to prepare it for underwriting, because you do have to go through a formal underwriting process, just like you're getting a new loan. You have to meet debt to income ratios. You got to meet certain credit score requirements. You have to meet sometimes cash reserve requirements and so forth. So it's not a bad idea to offer assistance to a prospective home buyer to help speed up that process if you know how to properly put together a loan file. Again, 1%. I don't know. Maybe that's reasonable. Maybe not. I'm thinking it's pretty much on a little bit on the high side. And then the other thing about when you're going to assume a loan, an existing loan, depending on the price of the house, you've got to make a cash down payment to cover the gap. The difference between the purchase price and the loan amount. And in some cases, that can be a pretty big gap. And for people who are looking to assume that loan, if they're short on down payment funds, then you've got another problem. You've got to cover that gap. And so what Rome does is they will refer, as their article says, and I actually went on their website, they'll refer you to one of their preferred lenders to arrange secondary financing to cover that gap. That's either a fixed rate second, or a lot of times it could be a HELOC. So in that respect, that is another factor in assuming an existing mortgage. You have to realize you either have to cover the gap between the purchase price and the loan amount. You have to have all that money for the down payment. If not, you're going to have to get a secondary loan. And of course, second mortgages are going to have a rate quite a bit higher than that 2 or 3% assumable loan. And so as a consequence, your blended rate, when you consider the cost of the secondary financing plus the low rate on that existing first mortgage, your blended rate could be, quite a bit higher than 2%. It could still be, better than current market, but it could easily be 4 or 5%, maybe even touching 6. So the point of all that is I'm not necessarily trying to promote Rome. I want to point out that if you've seen this article, it's just full of misinformation. I wanted to kind of clarify all that for you so you understand what this is really about. There isn't a mortgage company anywhere probably in the world that's offering 2% mortgages for new loans right now. So it's really, I think, kind of irresponsible for this writer to have used this kind of headline. But of course, that's the point, right, folks? It's clickbait. It's try to get your interest, draw you to the article, and then hopefully you'll pursue Rome and maybe seek them out if you are interested in buying a home with an assumable mortgage. But as always, as I say all the time, beware the headlines. I think this is a perfect example. So I'm done with that one. So I just want to let you know. And again, pay attention to some of these things that are being offered. Make sure you read all the details so you find out in short order what's really, really going on. So with that, we're going to kind of bring Jeff back because we have an interesting question this week that I want to cover. Jeff, I'm not hearing you.
There we go.
There you go. Okay.
Hey, before we move on, I want to ask you a question. Many times, we hear about these expert predictions and things of that nature, and then they never come true, or let's say a large majority of them never come true. But I don't hear anybody holding their feet to the fire. Because of this article, there are so many holes in it and as untruths, if you will. Have you noticed any follow-up content? Has anyone like yourself, gone and made them publicly, kind of held their feet to the fire and said, hey, this is not accurate. What else is not right here?
I have not seen much evidence of that. And, I've in fact, with this one, I contemplated, well, what if I need to do something to kind of call them on the carpet and let them know, or let the writer know that what she put in this article had a lot of misinformation. But, in general, I tend not to see a lot of follow-up to correct these kinds of situations. And, I think it has people these days, their attention span is so short. I've noticed now, particularly on financial articles, on the financial pages, a lot of times now at the top of the article where the headline is and, the date and the writer, who that is, there'll be a little indication of how long of a read is it? A 2-minute read, a 3-minute read, a 4-minute read. And you know what? You don't see a lot of 15-minute reads. Why is that? Because nobody wants to spend that much time reading it. And so many people are so prone to just want to read the headline. And then the next thing you know, they're at a cocktail party saying, hey, did you hear about that mortgage company offering 2% mortgage rates? And they're like, no, I didn't know about that. And then, off they go. So I don't know. I think there's just it's a very good point. I think there's just a really, really big lack of follow-up to correct some of this information. And I've seen it many times. It's really kind of frustrating.
Maybe we should carve out this piece that you did on that particular topic and send it to the writer and say, just thought I'd give you some additional information as a follow-up on this article.
Yeah, maybe I'll do that. That's a good idea, actually.
All right. Well, let's get into this week's question because I think it's a good one. It comes from our readers or our listeners, and it says, HECM reverse mortgage alternative. And, this is something I know you've spoken about in the past. And, reverse mortgages, as I would say, as our demographic continues to age, this is not an uncommon process for a lot of people to use as a reverse mortgage. But here's the question. My parents are near retirement and have a pretty high mortgage payment they hope to eliminate by getting a reverse mortgage. But they learned they can't get one large enough to pay off their existing mortgage. They want to stay in their home, but now they're worried. Art, the question is, do they have any other options?
Yeah, really good question. And in fact, I've actually got a case right now where I'm trying to help some homeowners wade through that challenge. And yeah, the point of that question, and I think what this person has experienced, is that we see cases where folks own a home, they're nearing or they're at retirement age. They do have a pretty sizable mortgage. Maybe it's a married couple, they're both working, but maybe one or both of them are near retirement, and they're starting to worry about, are they going to be able to financially handle their monthly obligations, including that fairly sizable mortgage, once they retire? Because what we see a lot now is folks who are retiring, they're not necessarily able to rely on some big, monthly pension that you used to see quite often, years and years ago. Now it's a much smaller universe of people who have that, that benefit. A lot of times it's public employees and so forth who end up being able to retire and get a really nice, hefty monthly pension check. But for most of us, that's not the case. And so you're facing retirement. You've got a pretty hefty mortgage. You're concerned about, once you do retire, particularly if you're going to rely on just nothing more than maybe Social Security. Maybe you do have some funds in the bank that's maybe going to throw off some income, but not maybe a huge amount. And so you get worried about how you're going to cover everything, including that mortgage payment. And so what will happen in that scenario is those folks will sometimes reach out to someone like us and inquire about getting a reverse mortgage. The core product being what we call a HECM, a home equity conversion mortgage. But then what happens is, in some cases, and we're seeing a good amount of this happening, when we run the numbers and provide a proposal, what we end up having to show them is that the amount of the reverse mortgage they can get is not sufficient to pay off their existing mortgage balance. There's a shortfall. And in some cases, the shortfall can be relatively significant, to the point where they either don't have the funds at all to cover that shortfall, or even if they do, they're worried about exhausting their cash reserves too much, depleting their cash reserves too much to cover that shortfall. So as a consequence, we get into a situation where, what do we do as an alternative? And by the way, this kind of scenario is fairly common in a case where, let's say, again, using a married couple as an example, one spouse may be quite a bit older than another. Now, remember, with a HECM, the minimum age of eligibility is 62, but with a married couple, you don't have to both be 62. You can have one be over 62, the other one can be under 62 in age. And like one I'm helping with right now, the one spouse is about 75, and the other spouse is about 60. And so as a consequence, where the HECM can kind of falter is the loan amount on the HECM is going to be based on the age of the youngest borrower, not the oldest. The implication of that is the loan amount you can get for the HECM is going to be smaller because the idea is the HECM is a negatively amortizing loan. The reason you're not making payments is because the interest that's due is simply reverting back to the balance, so the balance is growing over time. So to be prudent and to avoid defaults, the loan amount that will be set has to be low enough that there's a low risk of the home value being exceeded by the loan balance if it grows for too long of a period of time, to the point where it's more than the home value. So that's where we run into this problem quite a bit. So what's the solution? Well, it's a product that we offer, and it's really kind of a reverse mortgage hybrid. And it's really good for folks who we would describe as nearing or at pre-retirement, meaning that, they're both still working, but again, they see retirement in the future and they see a reduction in income in the future, but they still want to own their home. But they want to figure out a way, how do they reduce that mortgage debt, or how do they reduce that mortgage payment? And so this hybrid product is called Equity Avail. And so the way it works is, to be eligible, first of all, we would first look to see if you're eligible for a HECM, a reverse mortgage, where your current mortgage can be paid off in full. If you're not eligible for that, and you're going to have a shortfall, particularly a significant one, then you're eligible for the Equity Avail. And the Equity Avail is essentially a refinance of your existing first mortgage. And the way it works is your existing first mortgage has to have more than 10 years remaining on the term. And then if that's the case, you can get this loan refinanced into a new loan where your monthly payments are going to be partial interest only. And those monthly payments will continue for 10 years. So partial interest only means that what that payment is going to usually, in most cases, and one I'm working on now, the borrower is going from about $3,200 a month to $1,200 a month using the Equity Avail program. So they'll make that $1,200 a month payment for the next 10 years. It's a partial interest only. So there is still some interest that's due on the loan that's getting accrued to the balance on the new mortgage, the new Equity Avail mortgage. But the amount of interest accruing, of course, is going to be lower than if you got a HECM loan. And so then what happens after 10 years? Well, after 10 years, you don't have to make payments at all. That 10 years of a partial interest only payment goes away entirely. Then you essentially have what operates as just like a HECM reverse mortgage. The interest that's due on that loan is going to then continue to accrue to the balance, and it's going to grow over time. But because the loan amount was set at a level that's based on the age of the youngest borrower, because even with the Equity Avail, that's still the case. It's based on the age of the youngest borrower. The likelihood that the balance is going to grow beyond the home value is pretty low, because with HECM reverse mortgages as well as the Equity Avail, the proposals are based on a projected appreciation in home value of about 4% a year, which I think is pretty conservative, and I think bears out in the data that that's a valid number to rely on. So with that, what it does is it frees up your cash flow as you're nearing retirement. So then when you get to retirement and you're going to leave your job or jobs and you're going to then maybe convert to Social Security income, then this is going to give you that ability. It's going to position you to be able to continue to manage the mortgage debt on your home, but do so at a much more reasonable monthly payment level, and then being able to look in the future and see the opportunity that that mortgage payment will go away altogether. So this is the perfect alternative to the HECM reverse mortgage for those folks with a significant mortgage debt. They want to prepare for retirement. They're not there yet. They're in pre-retirement, as we call it, but they want to position themselves to financially be able to handle things so they can keep their home. Now, one other difference about the Equity Avail, you do have to qualify in a more traditional way. You do have to qualify based on debt ratio. There is a credit score limit. And on debt ratio, you have to meet a 43% debt ratio, which is the standard conforming first mortgage debt ratio guideline. So you do have to meet that. Although if you don't meet that based on your current income, you can still be qualified based on a residual income calculation in cases where your debt ratio is above 43%. But what we find is the reduction in the monthly payment with that partial interest only payment is usually enough that home buyer can still qualify for this Equity Avail loan and be able to take advantage of their pre-retirement and get their monthly expenses down, including that mortgage payment as they go into full retirement, and then be able to look forward to having that payment eliminated entirely after the 10-year period. So that's the alternative. I think it's a very good one. We're starting to see more and more cases where this is appropriate to look at. And so I would encourage anyone who's in that situation, thinking about pre-retirement and getting into full retirement, and you have a decent sized mortgage and you'd like to find some solutions for that, give me a call. I'd be happy to, have a consultation with you and see if we can help you, prepare for your retirement in a comfortable and financially secure way. Jeff, back to you.
Yeah, that seems like a great idea. I didn't know that existed. And you call that Equity Avail.
Equity Avail, yes. Uh-huh.
Yeah, you answered that question like, okay, I'm sitting here taking notes going, okay, well, what happens in after 10 years? And when you say you just stop making payments. Well,
right.
So it's really a good idea. And in my head, I'm thinking, okay, well, this is a perfect opportunity then to connect with somebody who says, okay, how much of that savings now can be put into some kind of investment vehicle? So when you do fully retire in 10 years, that will now make up a difference for you. That's a nice, gives you a nice 10-year runway to start building up some other revenue if you can't afford it, of course.
Well, that's exactly right. Because in particular, if you're eligible for this program, you do have to be 55 at a minimum. So one of the, both spouses have to be 55 or older. And in a lot of these cases, one or both are still working, But again, they're planning ahead, and they can see that period of time when that employment income is not going to be there, and they're going to have to rely on retirement. And if it's going to be Social Security and so forth, they can see where their income is going to be lower, and this gives them an ability to plan ahead and position themselves for when that occurs. And then the other thing that we get asked about a lot with this product is, okay, so what about paying it off? When do we have to pay it off? Well, it's like a reverse mortgage. You pay it off either when you move out of the home, either because you sell it because you want to live somewhere else, or worst case, your health is deteriorated to the point where you have to go into, vacate the home and go into assisted living and have to do that for beyond 12 months. Or when the owner passes away, the owner, in the case of a married couple, when the last owner passes away. So for that younger spouse who is expected to live longer than the older one, that person doesn't have to worry about when the older spouse does pass away, that they suddenly are faced with having to hurry up and pay this loan off. They can stay in the home until they pass away too, and then their estate will take care of disposing of the home or keeping it and refinancing it.
I just want to ask a real quick follow-up question on that, because it's something my wife brought up the other day. She said, well, there was a point when this reverse mortgages had a bad name and a bad rap, but they really weren't called reverse mortgages back then, or were they?
They were.
Okay.
No, they were. Yeah, they were called reverse mortgages. And reverse mortgages have been around for a remarkably long time. I mean, literally going back to like the 80s. And they just didn't really get much traction, I think, until really the last, couple of decades. And of course, as you pointed out earlier, I mean, when you look at demographics, I mean, we've got a whole bunch of baby boomers who are aging. And of course, they're kind of being criticized now for having, kind of got all the home ownership and, shutting out the younger generations. It's funny to see those kind of articles. But yeah, I mean, there's a lot of, baby boomers, people our age who own homes, but they're aging, and they're going to be retiring, and so reverse mortgage as a product is expected to see some pretty good growth because of that segment of the population. Those homeowners are going to need this kind of product to help plan for retirement and do so securely. So.
And this is something that you can help someone who's watching this today or
Yep.
recorded, that you can help them out.
Yep. Sure can.
Right.
Yep. Mm-hmm.
So if you're in that situation, just give Art a call at 760-883-5700. Art, with that, we're going to turn it over to last week's closing question.
Okay, sounds good. Thanks, Jeff. Okay, last week's closing question, we'll get right into it. I'm self-employed, would like to buy a home, but I've been told my tax returns don't support getting a mortgage due to a high debt-to-income ratio. Instead, I've been advised to consider a bank statement program. Can you explain what that is and how it works? Of course, a lot of you may have already heard of this program. It's become a pretty popular, probably I would say the core product in what we call the non-QM, the non-qualified mortgage space, to use current vernacular. And the purpose of this product is it's designed specifically for self-employed borrowers. That's what this program is for. The idea is we use bank statements to determine your qualifying income. So in that respect, we're looking really more at cash flow than how you report your income for tax purposes. And the core approach is to use either 12 or 24 months of bank statements. And that can be, though, personal or business bank statements. And it's intended for borrowers with 50% or more of their self-employment income. So in other words, 50% or more of their income should be self-employment income. Now, one key distinction or one key aspect of a bank statement program is if you are self-employed and you have a business, the business must provide a product or service. I bring that up because at times we've had inquiries where somebody wants to get qualified based on their bank statements, and they don't, they consider themselves self-employed, but yet maybe their business bank statements don't support getting qualified with this approach either, but they want to use, deposit activity into their bank statements, whether it's business or personal, from maybe some other, passive income source, such as an installment sale note where they're receiving note income every month. Unfortunately, that kind of income is not used for a bank statement program. If you have passive income, you're going to have to support that with tax returns, which of course, if you're also self-employed as well, that's going to probably violate your ability to use or to get qualified for the mortgage because of having to provide your bank statement. So again, your business must provide a product or service. But at the same time, let's say you're married, you've got a spouse who's, a regular wage earner, or your spouse is on Social Security. We can still combine certain types of non-business income in the loan file with this approach. So if you're on, the other borrowers on Social Security, or there's rental income, or they're a W-2 wage earner, we can use that income in addition to the bank statements for the person, the spouse, the borrower who is self-employed. Now, typically what happens is when we get these bank statements, the deposit activity is analyzed, tallied up over the 12 or 24 month period. And the standard approach is to take that total deposit activity, divide it in half, take a 50% 50% expense ratio, and then use that remaining portion and divide it by the period 12 months or 24 to get your monthly qualifying income, where a debt ratio is calculated. Now, some businesses, if you're a service business in particular, where you have low needs in terms of FF&E, furniture, fixtures, expenditures, things like that, you can challenge the 50% debt ratio approach and get it lowered. You typically have to get the help of a third party to get an expense statement or expense declaration, such as a CPA or a tax preparer, where they will certify that your expense ratio, because of the type of business you have, maybe you're a sole business owner, you don't have employees, or maybe your expenses are not 50% of your gross business income. So there is a possibility of using a lower expense ratio to help get that monthly income higher. You can use just strictly 100% personal deposits with evidence that of a separate business account to show the transfers from the business account to the personal account. You do have to be 2 years of self-employment. So if you're only self-employed for a year or less than a year or a year and a half, that's going to be problematic. You do need to have a 2 years of self-employment verified. And you do have to have a minimum of 25% ownership. And if you have multiple business accounts, that is okay. The point of that, though, is if you're less than 25% owner of a business, you're not going to be able to use a business bank statement program to be qualified to get the mortgage. And believe it or not, in some markets, this program, you can get loan to values as high as 90%. That's fairly rare. I mean, there's not that many markets where that's available. I would say on average, in most cases, plan on at least as high as 85% loan to value. That's still a 15% down payment. That's relatively modest in most cases and can usually help most self-employed borrowers. They can usually come up with that kind of down payment because if they are running a successful business, their business deposit activity and their business assets usually can support that kind of down payment amount. So good question. It's something that we are using quite a bit. I've got a couple of these going right now. We do these, fairly often. It's a great alternative. In fact, I've got one right now. The loan amount's going to be $1 million, and we can actually get them an interest rate just under 7%, which is frankly very, very close to a jumbo mortgage where you're providing your tax returns and can qualify that way. So these loans, particularly the way we price them, because remember, we price our loans very aggressively in terms of how much compensation we require from the lender we deliver the loans to, we can provide extremely attractive rates for this type of program. So if you're contemplating this kind of program, or you're talking to another lender about this kind of program, check with us. We'd be happy to give you a no obligation worksheet so we can at least help you do a price comparison. I think you'll find that we can offer some pretty attractive rates with this kind of program. So good question. Hope that helps. And with that, we're going to go to the last question, the closing question for next week. And this is one I just encountered just the other day, so I thought it would be a good one to cover. And here it is. I was in the Coast Guard in the past, obviously. Would that make me eligible for a zero down VA loan? Good question. And next week, tune in because I'll have the answer and it'll be on the house. Jeff, back to you.
Art, you leave us always with a cliffhanger. That's a good one.
Yeah.
I was like leaning. I thought you were going to give us an answer. I thought maybe you were just going to let us have a little inside peek on that. But tune in next week for that. Art, some of the numbers you shared at the very beginning, it's kind of like good news, bad news. It's good news for the economy that it's still doing well, but it's bad news when it comes to people who or it could be considered bad news, people who are trying to buy a home. But you said something I thought that was very significant. Hey, buy now and take advantage of everything you can. Like as an example, we were talking before the show about using a buy down. So you take a buy down and that gives you, the 3-2-1 or the 2-1, that gives you a couple, 3 years for those rates to go down. And then at that point, couldn't they just refinance and then lock in with a lower rate at that point?
Well, exactly right. And this is something I keep talking about. And whenever I can, when I'm out there, at different events and particularly realtor events, I always, in fact, again, yesterday I was at the Palm Springs Realtors weekly caravan meeting, and I was talking to an agent. I see there every week. I know him well. I've done business with him. I'm, helped him with many of his buyers. I've done loans for him personally. And he was moaning and groaning about he's got a listing that's becoming stale, and the home is listed at $540,000, and he thinks they should be listed at $480,000, but the seller wouldn't let him do it. But they're at the point where they feel like they're going to have to go ahead and lower the price. And I said, stop. Before you lower that price, let me show you how you can use a 3-2-1 buy down and maybe not lower the price as much. In fact, I told him, I said, if you think it should be at 480 and it's at 540, yeah, there's probably some price reduction appropriate there, but don't take it to 480. First of all, you won't convince the seller to do that. Maybe talk that owner into 5.25. And then, for the cost of about 20 to 25,000, you can, convince the seller to offer a credit to the buyer so that maybe their net will still be around 500, not 480. And we can then use that credit from your owner, from your seller, and provide that prospective buyer a 3-2-1 buy down. It's going to save them at that kind of price level, probably $800 a month first year.
Wow. And
they got a 3-year window to watch mortgage rates to come down so they can refinance that note rate into a lower rate. They've got a 3-year one-sided bet for mortgage rates to fall and then strike for that refi, and then they're set for long term. So I'm talking about it all the time. I encourage anybody who's on the sidelines about buying a home. There are some houses out there that are on the market for starting to be 30, 40 days plus. Those are the kind of houses, if they're in decent shape, something you like, you think you can be happy with, don't just go after those with low price offers. Talk to somebody like us. We can help you do the numbers and show you there's a better way.
Well, one thing I like about this, it takes me back to my old selling days. I said, people don't buy because of similarities. They buy because of differences. And with so few, I don't want to call them out in a negative way, but so few agents and buyers realizing this tactic or this strategy is even available. If all of a sudden, there's a list of 10 homes and you're the only one offering these low rates, to me, it's like, it's an attention getter. You got to go check it out, right?
Right. And again, that's what builders do. They always have. And resale agents and the resale markets need to do more of that.
Yeah, I think that's going to help them compete. Well, you see Art's information on here. It's MortgageWorks, Art Alvarez, 760-883-5700. That's the office number. And then his cell phone number, 714-612-9035. Website, you can always go there at mwloan.com. And as you saw at the beginning, there's all kinds of additional tools on there just besides the consistent updated rate chart. There's all kinds of loan assistant information in there that you can get in there. So reach out to art at mwloan.com. I think there's some great information there. And remember, the longer you wait, the more prices could change. And I was thinking about this just a little bit is, I look around this just in the Coachella Valley, and this is a small example of what's going on in the country, but there's a lot of property being built. There's a lot of multifamily, a lot of new homes being built. That's going to come on the market, right? And it's not going to be cheaper. So do it now.
Yep, so. Exactly right.
Well, Art, as always, you do a great job. Thank you for keeping us up to date with what's happening, and we'll see you next week.
Okay, sounds good. Take care, Jeff. Thank you, everyone. Thank you for watching and listening this week's Mortgage Minute. Stay tuned for next week. I hope to see you then at next week's Mortgage Minute. I'm Art Alvarez with Mortgageworks, where we have the answers and they're on the house. So long. Take care.